Mm. Can you guys see my screen right now? Okay. So, good evening and welcome to the Hoperation Fund Reading Club. Today we're gonna go over the book, The Little Book of Common Sense Investing by John C. Bogle. So hopefully you guys have already read like the entire book already. First of all, though, does anyone want to comment on what they thought the book was mainly about or what they learned from this book? Okay, Chloe?
I honestly thought the book was mainly about you should invest in index funds instead of mutual funds, and basically they talked about that for like a lot of chapters, honestly.
Yeah, it did. It had a lot of evidence and reasoning behind how index funds are really good or superior to most mutual funds. So yeah, great. Livia?
I learned that there was an even bigger difference between the amount of profits that you get between using an index and mutual fund. It was kind of surprising how big of a gap it was.
Oh yeah, I know, right? When it showed all of that evidence on how these differences and like the returns can like lead to a lot of like gigantic gaps in like the total returns. Yeah. Yeah, like that like really gave me like a lot of inspiration. Like I guess like I didn't know there would be that much of a gap between the returns of index funds and the average mutual fund. So overall, here's just like a summary of what I thought the book was about. So the Little Book of Common Sense Investing mostly promoted the investment strategy of buying and holding a diversified portfolio of low-cost index funds. But the author argued that to this approach, as opposed to attempting to beat the market through active fund management, will yield better investment returns over time. This is because, as he said before, in the book, like there's low cost with index funds, and the efficiency of financial markets will also yield better returns. So I summarized this in 5 key points. Number one, the power of compounding. As Livia said, the author emphasized how compound interest works in favor of the long-term investor, particularly when there's minimized costs and fees like management fees. Number two, also, by the way, for compounding, we're gonna do a case study after about the power of compounding over the long term. Number two, that costs matter. This is also like a key point, as high fees associated with active management can significantly eat into returns. Since index funds usually have lower fees, they usually have like better total returns. Number three, focusing on simplicity. So investing in a broad stock market index fund is recommended because it is simple, diversified, and less risky than picking individual stocks or trying to time the market, and usually yields in better returns. Number four, long-term investing. So the author Bogle advised against frequent trading and market timing, promoting or advocating instead for patience and discipline and sticking to a long-term investment strategy. And number five, the role of emotions in investing. So basically, this book warned against the emotional pitfalls that can lead investors to make irrational decisions, like panic selling or buying at like really high prices. Okay, so now let's just move on to some questions for this book we can discuss. Number one, Bogle, the author, makes a strong case for index funds. So why does he think the winning strategy is to own index funds? Or put in another way, what are Bogle's reasons for holding index funds? Also for this reading club, I would like greatly advise people to like answer or like to participate, because even usually a lot of these questions are open-ended, but even so, you don't need to be afraid of like I don't know, saying the wrong thing or something, because after all, the important thing is to like learn, and to discuss. And even though I sound kind of cheesy, yeah, that's still the truth. The important thing is to like discuss and like participate. So since Chloe raised her hand first, Chloe?
Um, he suggests because the transactions fees and all of the costs are lower than the mutual funds, and even mutual funds are ran more passively, doesn't mean the returns are higher than index funds. I think he made some like reports where index funds had higher earnings, higher report earnings than mutual funds. So yeah.
Oh yeah, that's really interesting, Chloe. Um, so, oh, okay, whatever. Um, Isabella?
The author was also talking about how index funds had like the greatest possible like tax efficiency, so there wasn't as much tax on it. And also there was a lot of diversification, so you could just earn more in general. Yeah, and you could also buy index funds for less money, and then eventually over time you would earn more, so you get a lot of profit.
Yeah, exactly, Isabella. That's like spot on. So I just say like the author, he thinks the winning strategy is to own index funds overall, because index funds have like much lower like costs or fees than like things like mutual funds. They're way simpler. Like instead of like picking stocks or like trying to time the market, they're way simpler, more diversified, and overall they have much higher returns than the average mutual fund. So on the other hand, while the author like talks about how index funds like really great and stuff, and while he makes a strong case, are there situations where active management might be preferable, or like active management, managers, mutual funds might have higher returns or might be better than index funds? And this is just like in your opinion, you know. Okay, does anyone besides Chloe want to like participate, like answer this? It's like really based mostly on your opinion, like there's like a few situations where active management might be preferable. Mm. And again, I, I would highly suggest like you participate in this. Mm. So you can like it can better contribute to like your learning experience. Mm? Hold on, someone's flooding my chat. Uh, oh. Oh yeah. Lou said when there are extremes on the stock market. Yeah. Actually, I'm gonna go over that later. Like with active management, if there's like big ups and downs on the stock market, active management can prevent like gigantic losses and stuff. It can actually be sometimes it's a little bit stabler. Because like the managers can like respond in time and like change the portfolios usually. So Chloe.
So like what she said, like when they help you with like your portfolios, like decisions you have with portfolios, like whether you should like sell stock, and like they give you like some advice. They don't really like um choose the stocks and you have to pay fees that high. They just give you some like tips when you really need help.
Yeah, that's really interesting too. Because like yeah, managers like they can give you like tips sometimes. Like sometimes they can actually give you like good tips as the book said. Um, Aurora?
Yeah, so maybe in certain market segments when there are like less efficiency or like when active managers have like historically been able to outperform the market consistently, like it may be a better option.
Yeah, excellent. Excellent, Aurora. So like, sometimes managers can like have higher returns, right? So actually I'm gonna cover that. So although the majority of active managers do not consistently outperform the market after fees, sometimes there are indeed a few skilled active managers who consistently outperform the market after fees, such as Peter Lynch or James Simons. This is James Simons, by the way. Like the book said that the average mutual fund can't outperform the index fund, right? But there's always gonna be like a top percentile of managers who like have really high returns or who can outperform the market. Um, Previously I think we read a book about one of Peter Lynch's books, One Up on Wall Street. And it showed like how like active managers can have like really high returns too. In fact, James Simons, you can see from here, has had a 66.1% average gross annual return. That's 66% return every year, which is like really, really high. Like that's way higher than the average index fund. So you can see like a few like really skilled exceptional managers can consistently outperform the market. And this is like over a really long time period, like 30 years. Another thing, as Lulu mentioned, is that active management can help you avoid stock crashes or big losses. So here's like, oh yeah, I'm gonna pull this up. Here's like a chart of the S&P 500 from 1999 to 2009. As you can see, it has a like gigantic like losses here in these bear markets from 2001 to 2003 and the 2008 bear market. You can see while the initial balance was $1,000 if you started at the beginning, the final balance was only $1,088. So you only got $88 in 11 years because there were like some major bear markets here. And the max drawdown was actually negative 50%. But however, if you have like active management, since like managers they can like react and like maybe like do some hedges or like adjust your portfolio, this can sometimes help you avoid stock crashes or big losses sometimes. Um, for example, my basic quantitative model. I have a YouTube video on this. So while you see if you invested $1,000 in the index fund of of the S&P 500 and held it, you would only have a final balance of 1,088. If you use my basic quantitative model, you would get a final balance of 2,587. Because usually these like portfolios can like are adjusted and can like have like smaller losses. As you can see, my worst year was negative 5%, 5.8%, and while SPY's worst year was negative 36.8%. And later you can, if you want, I can give you guys the link. This is just to well, not that guy. To a portfolio. Yeah. So this quantitative model can help you avoid the stock crashes in 2000 to 2001 and in 2008. Okay, moving on to the second question. The author discussed the impact of fees on investment returns. How aware were you of the fees you pay, and how might this awareness affect your future investment choices? Let's see, Olivia.
So at first I was like unaware about like how many fees you had to pay, but like now that I know, I might not invest that much in the stocks that I might have to like pay a ton of money for. Because then I might just be losing money.
Yeah, amazing, Olivia. So, yeah, I agree. So this book like really put you like really made me aware of like the impact of fees over the long term on like the returns of like your portfolio. Isabella?
I was kind of aware of like trading costs, but not really on like tax efficiency and stuff like that. So I think when I invest in the future, I'll be more careful towards like trading like these hot and cold stocks. And yeah.
Yeah, excellent, Isabella. Yeah, again, like this book really like put you like made you like, or at least made me aware of like the impact of fees. Because usually most people, I guess, look at like fundamentals and like the returns of a stock or portfolio, not exactly on fees that much. Oh yeah, speaking of which, Lulu, is your microphone working?
Kind of. Oh, it's working now because last time I was online, my microphone was like really quiet, so I thought I'd just stick to the chat.
Okay, no problem. But like if your microphone is working though, maybe like you could like may like usually we mostly like raise our hands, so maybe you could like speak out loud so to more participate into the discussion. But anyways, thank you for like sharing in the chat, because usually sometimes I like don't look at the chat for a long while, so I kind of like miss some answers. But anyways, thanks for sharing. Um. Ah, okay. So generally, an index ETF has a very low fee. The expense ratios for the Spider S&P 500 ETF trusts or SPY, iShares Core S&P 500 ETF, IVV, Vanguard 500 Index Fund VOO. Actually, the author of our book today actually created this index fund. And the Spider portfolio S&P 500 ETF SPLG. So like the expense ratios for these are like really small usually. Like this one for SPY it's 0.095%. For IVV it's 0.03%. For VOO it's 0.03%. And for SPOG it's 0.02%. Like really small, compared to, for example, mutual funds. However, actively managed funds or ETFs usually have higher management fees. Okay, next question. Bogle emphasized the importance of diversification. Based on his book, why do we need to diversify our investment portfolio? Like, why do you think we need to? Max?
Can y'all hear me?
Yeah.
All right. So diversification. So like in terms like of like a sector, if a sector falls, if a sector grows, your losses are never going to be great. So you're more intact. You're more stable and intact in terms of your earnings, and you represent the overall market more when you have diversified sectors. Yeah.
Yeah, that's really good, Max. Exactly. So diversification can be more stable. Does anyone else want to share? Valencia, did you raise your hand, by the way? Or
Yeah. I agree with Max. Also, that if, say, one company fails or a stock fails, then you aren't gonna lose all your money, and you'll still have other.
yeah, excellent, exactly. Um, Yeah, I'm great. Most of you like since you guys are all raising your hands, you guys like mostly um know mostly about this or familiar with the importance of diversification. Mm, so again, here's like some charts of stocks of like this portfolio of 60% stocks and bonds and 40% bonds, I think. Um and this Boglehead Street Funds, this is like a pretty famous portfolio, I think. And the Spider S&P 500 ETF Trust. So as you can see, um these diversified portfolios have much like have pretty much less risk than the average market. For example, the worst year is -20% and -30% respectively, compared to the market's -36%. And the max drawdowns are also lower. And even you can see the final balance is even higher than the market. It's like around 1,500, and you can see these are the two diversified portfolios. They have much higher returns than the S&P 500. And fourth, the book promotes long-term investing. So how easy or difficult do you find it to maintain a long-term perspective, especially during market volatility? Okay, yeah, this is again a pretty open-ended question. Just like how you personally would find it to maintain like long-term investing if the market has gigantic decreases or like gigantic gains. So I see Max. And this is pretty much an open-ended question, just like your own opinion.
So, so essentially, he was like, don't trust your emotions. So during market volatility, so just keep maintaining the fact that you're representing the market. Because when you have it in as fund, when the market goes down, don't want to sell because then that interest fees not likely good for you. So he said, so his ideology overall is just keep it, don't allow emotions to go through, and put it into the bonds indexes that will ensure your long-term growth.
Great, Max. Yeah, the book mostly promoted like long-term investing. Um, Personally, I'm just curious. Would you find it like personally, would you find it like really easy to like continue long-term investing if the market has gigantic like ups and downs, or would you find it like pretty difficult? Max? Mm.
What?
Would you like I'm just curious, how easy or difficult would you find it if like the market like
I guess I would just like ignore it mostly. If the market goes down, I might buy a little bit more, generally speaking, and just like keep it. I guess just hold as of right now. However, just saying, I do have like quite a bit in stocks right now, so I might want to buy more indexes to like sort of even out the diversification.
nice? Well, it's great that you're investing in stocks. So Olivia?
I feel like if I tried to forget about it, then it might be easier. But if I was constantly like worrying that something might happen, I might lose like $1 billion, then I feel like it would be really hard and I would come like really close to selling it, but then like disappointment may like make me not.
Yeah, I know. Most people would like be pretty nervous. Like sometimes the market can go down like 50%. So and like if you try to ignore it and you didn't really look at the stock market, maybe you could ignore it. But like sometimes like many people find it like really hard to like focus on long-term investing and not sell their stocks when the market goes down a lot. So next up my list is William. Do you want to answer?
Okay, because you can't really control how the market shifts, right? So, generally through long-term investing, the market's obviously gonna have like ups and downs. But I feel like when the market's really high, like you have to be careful because at some point it's gonna start decreasing. But when it's really low, I think you should buy a lot of bonds because it's gonna increase again at some point, right? So if it's going to increase again, and then you do have to be cautious though, because like the greater like stocks, I feel like it's kind of like a high risk, high reward thing. So yeah.
Yeah, I agree actually, William. And I think Warren Buffett agrees with you too. I'm gonna share his quote, like his opinion on this too. Because markets they'll go up after a while, especially the U.S. market. So like when the market goes down or as like it's pretty down, and sometimes it can be a good chance to like buy stocks, no? And of course stocks like they do have high risk. So um maybe you should be like pretty prepared too. Great. Mm, and finally, Lulu.
Um, I guess like the logical thing would be like to like take advantage of like the low stock market and like buy more. But like to be honest, I would probably be that one person who freaked out and sold everything.
Yeah. Um. Honestly, I feel like it can be really hard if you're at the top of like the stock market and then suddenly it goes down a lot. Like I would, yeah, I would freak out too. I would like sell a lot of my shares too, because honestly, it can have like emotional damage sometimes. Like it can be kind of scary. Um. Nice quote, William. Um. Yeah, this is a really famous quote, I think, by Warren Buffett. Mm. So some people, for example, Warren Buffett, um, um, say that price volatility is not a risk, but it is a chance to buy excellent companies at a reasonable price. For example, as William said, when the stock market goes really low, it's a good chance to buy companies at a really low price. And there are Warren Buffett also likes to diversify his portfolio. So during the market volatility, there's not as much risk. My strategy is to hedge the risks from the collapse of an entire financial system or an entire market. So like a hedge fund is usually like the opposite of like the market. Like when the market goes down, it goes up. When the market goes up, it goes down. So I would recommend personally, I myself like use some hedge funds or stuff, or hedge stocks that um like basically may that basically decrease the risks from the collapse of a market, and it can make it like much stabler. And of course, like usually when a market goes up and down, there's a lot of volatility. I would get really scared too, though. And yeah, so this is like just like a picture of what you might consider long-term investing usually, and actual long-term investing when the market goes up and down. So yeah, it's kind of funny. Okay. And finally, let's go on to the fifth question. So, how does I'm assuming like you read other investment books. So, how does Bogle's advice compare with other investment books you might have read? Are there contradictory or like opposite strategies, and what do you think of their opinions? For example, before we read Peter Lynch's One Up on Wall Street, once, and I think some people might remember that. Um, so oh yeah, there's like Peter Lynch, like he has like some different like strategies. For example, he doesn't while he approves of index funds, since he's like more of like a mutual fund manager, he like has a lot of strategies on how to invest in stocks and stuff. So what do you think of their opinions? Like this is a open-ended question. Honestly, there's no right or wrong answer. You can if you really like think so, you can say that this John C. Bogle is absolute trash and you don't agree with him at all, and that's okay. But if you agree with him a lot, you could just say so. And yeah, Isabella.
So I actually have the Peter Lynch book right here. But it says on here, like I kind of remember too, that he said as long as you do like a bit of research, then you should be able to maybe pick your own winning stock, like mutual funds or stuff like that, and earn money. But Mr. Bogle or Boogle, I don't kind of Boogle, I'll call him Boogle, yeah. Um, Well, he says, index funds, right? Don't even touch mutual funds. He doesn't care if you research or whatnot. Index funds is the way to go. I think if you combine their ways together, you'll be quite successful because I remember there's this other book and the dude was like, you have to be safe, but you also need to take risks. So that way you can earn like more profit.
Nice, Isabella. That's a really good perspective, actually. Also, I'm curious, what book was that?
It was just the one up on Wall Street,
Mm.
this book.
Oh,
Yeah.
you got it from that book?
Yeah, we read it like last year, I think. Yeah.
So nice. That's really good. Olivia?
I feel like many investment books are pretty general. I feel like a lot of the times they either suggest like index funds or mutual funds. I feel like they don't usually suggest going for just like a company because there's a lot more risk in those. But I do feel like they say pretty much the same things like make good decisions, don't buy everything and then sell it when you're low. But that's just my opinion.
Yeah, again, like not, but that's excellent, Livia. And yeah, I agree too. Like you shouldn't buy something when it's like super high and like the prices are inflated, and then sell it when it's at the pit bottom. Um, William and Angela. Also, are you two people answering, or is it just like one person?
It's mainly just me, and then she's just like an NPC.
No.
Okay. Um, I like mainly agree with Bogle because I think like in life, if you wanna have like multiple income streams, like if you get fired from your job, then if you only have one income stream supporting you, then you're just gonna fall apart. But if you have like multiple income streams, like from stocks, from like real estate, and you lose your job, like it's not gonna impact you as much. So like about what he said, like about buying the entire haystack instead of looking for the needle. Like I feel like that's true for the most part.
Yeah, so you agree with Bogle's opinion? Same. Like I believe all of these like people have like really good opinions. Like they all have a lot of merits. So yeah. Kai?
Uh, like I read from a lot of other books that say like you can look around you and then you'll find a lot of like good stocks.
I think that's peeling.
Yeah, that is. Oh yeah, probably because I've read a few. I don't know which one it was.
Well, it might have been another author.
Yeah.
Yeah. So yeah, you agree with that. Yeah. Overall though, these are all really good. Hmm? These are all like every author has like really good like an opinion, right? They all have like solid good reasons. And like if you read like a lot of investment books, you'll find that each author has different opinions, and usually they have like solid evidence or solid reasons. Um Anyways, thank you guys all for sharing. That was really cool actually to see all those perspectives. Chloe, did you want to add something?
My bad. I was like doing the first question.
Oh, sixth question? Okay, so this is one of our last question that we have one more question after this, and then we have some case studies. So number 6, what is the most important lesson you've taken from this book, and how do you plan to apply it to your investing? Again, this is like a really open question, and you don't have to answer immediately. You can just think about it for a while. Um, and Chloe, since you're so eager to answer, I'll call you first.
I think the most important lesson I learned from this book is really like think of long-term investing and like doesn't mean market when like market goes down you have to sell because markets will go up and if you buy stocks you're going to lose money sometimes. So you can't just always expect like winning money. And then I also learned like around like expenses matter and you should buy index funds instead of mutual funds and other stuff really.
Amazing, Chloe. So there's a lot of important lessons like you can take from this book. Lulu?
I guess index funds are pretty helpful for people who don't really have any like, I guess, in like investing expertise and like they're just like trying to invest and like they're not going to spend too much money on it. And like, um, if like the stock market is like going down, don't panic. Like you can take advantage of it. You know, it's not the end of the world if the stock market is plunging like there's and stuff. And then like I guess there's also some parts I disagree with it because like like mutual funds are not like that bad. I feel like even though I'm pretty new to investing, so I don't really know. I guess the most important lesson, stock market goes up and down. Keep your stocks, I guess.
Yeah, that's really good, Lulu. Um, again, this book has a lot of important lessons, and you can also like disagree about some stuff too. Like I agree, like um I guess like a lot of mutual funds maybe aren't that bad, but some definitely aren't. Maybe this author saw a lot of like maybe the average mutual fund isn't that good. Uh, though Max,
Okay, so my most important lesson, I guess, is to like so have your account become more defensive so that it doesn't so that it follows the market because as a 13-year-old, beating the market is pretty hard. So just keep it based off the market and that it will generally assure you success because because the American economy is generally growing.
I know, right? Since like we're pretty young, honestly, I don't think we have like that much energy or focus to like research them as stocks or time really. I guess because we're not exactly professional. Um, eh, so I would recommend like if you don't know that much to just like invest in index funds or anything. Because usually like they give like really good returns. William.
I think like in a lesson that I've taken from the book is that like just use index funds because they're generally more stable. So like if you pick a specific if you pick a specific stock, like say that stock like crashes, that's much worse than you picking like for example the S&P 500. Like it's more stable because you have a lot of different stocks. It's like a combination of all like the top 500 best stocks. So yeah, I guess one lesson that I've learned is just like be careful, but also like buy a lot of stocks.
Amazing, William. Again, like, that's like really cool to hear like all of you guys' perspectives. Mm. And thank you guys, for like, being like so eager to participate. Mm. And again, like participating is really good, because like you shouldn't be that afraid. You shouldn't be really afraid to like I know, like say something wrong or anything, because really you can't exactly say something wrong, and honestly, the important thing is like just to participate and learn, you know? Okay. And so finally, I have this activity before we move on to our case studies. So I noticed a lot of you include like really good quotes from like a book or from a famous investor. So here is a Google document where you can write down the sentences from the book you like the most. So for example, you can write your name, um, Olivia Zhang, and a sentence like I love index I love index funds or something, and then the chapter where you got the book from. And why are you? Some of you might not like, because I noticed a lot of you like to include quotes. I thought this might be a pretty fun activity too. So I will share the link in a minute. It's okay. Okay, here you go. So could everyone please like fill out this like Google document? It would be pretty fun to see like which sentences people think are the most inspirational. Mm. And like if you can't come up with something like you can like use your book, and you can take a lot of time honestly to flip through it. I don't care. You don't have to like answer immediately. Wait, I might do one too. Hold on. Actually, there are a lot. Might you know what? I'll do this actually. Hmm. Speaking of which, I would recommend like you do a quote from the book, but if you really can't like find one, like you can use a quote from like an investor or anything. Mm. Okay. Does anyone like need a few more minutes, or is everyone done? Okay, if you're on, you can do more than one actually. You can if you want like if you have a lot of quotes, you can do like more than one. Okay, so I'm gonna read these. I'm gonna give you guys 2 more minutes then. I'll read it then. Okay. Well, 1 minute, and then since you guys have written a lot, then okay. Okay, then I won't read them then, but we can like just like you can just like look at them. It's pretty cool actually. Yeah, these quotes are all really good actually. Mhm. Mm, okay then. Overall, thank you guys for filling this out. It looks great. If you want to do if you want to like add another quote, you can do this later actually. But now right now, because we are a little bit short on time, let's move on. Okay, so now let's move on to our case studies. This one is about the compound effect. So consider two investment portfolios, Portfolio A and Portfolio B. Portfolio A has a compound annual growth rate, or a CAGR, basically like uh, an annual return compounded of 15%, while Portfolio B has a CAGR of 17%. If each portfolio starts with the same initial investment, what will be the percentage difference in their total values after 30 years? So you can guess this. Like, what do you think? You can fill in the blank. Portfolio B's value is larger than Portfolio A's by approximately what percent? You don't need to do any math here, actually, just to guess. Like, after 30 years, what percent do you think Portfolio B's value will be larger than Portfolio A's? Oh, yeah, William?
I guess like
35%.
okay. I'm guessing like probably around like 20 to 25.
Okay, so Angela, you said 35%, and William, you said like 25? Okay, that's cool. Well, we can see who will be closer then. Who else? Does anyone want to share? Okay, just if you don't know, just put out a random number then. Chloe?
Wait. I'm not so sure yet, honestly. Actually, never mind.
Uh, you don't need to be sure. It's like you don't need to be afraid of getting it wrong. I bet most people will get it wrong actually. Because I got it wrong too. I got it wrong by a lot. Actually, when I like first saw this. Uh, okay, Livia then.
If it were like, if I hadn't thought about it, I would have said 2%, but it's compound interest, or compound growth rate. So, I think I'd guess like 63.
Oh, you guessed 63.
63.
Cool. Nice. Uh, Daniel?
45%.
Okay, 45. Ooh, the answers are coming on in. We should see afterward who's closest. Lulu?
Maybe I'm pushing it a little bit. I guess like 75.
Oh, 75. Yeah, that's nice. Okay, does anyone else have any more?
Maybe like 17%.
17? Interesting. Chloe?
Like 85%.
85? Nice. William said he changed it to 50%. But Valencia said 70-ish%. Okay, let's see then. Actually, the chart for the annualized compound rate is like this. So actually, I think Valencia, Livia, I think maybe Lulu, finish. Well, some other people too. I think I'm like missing like 2 people, but whatever. So yeah, the actual difference is about 70%. This is almost double. But yeah, almost double. You can see there's a gigantic gap between the returns in like 30 years. Like even an investment return that differs by only 2% results in like this gigantic gap. It's like almost like 65, 70-ish percent. You can see here, while at first the gap doesn't seem that large, since it's compounded over time, like the gap becomes like super large. Okay. So yeah, you guys were like actually really close. Almost if you honestly, personally, I myself, first time I would guess like 35%. About okay. So this is like really interesting, right? It just shows like the power of of compounding. Okay, now let's move on to our next case study. How to evaluate the portfolio. So given two or more portfolios, for example, these are like some famous portfolios, how would you personally select the best one? Like this is again a pretty open-ended question. Many people like have a lot of different answers. Livia?
I would like do some research and I wouldn't decide based only on like the returns, but like how much it like fluctuates. And other things that might bring it down, like if it invests in stock or market or stocks that might not be doing well, etc.
Yeah, I agree, Livia. So you just like look at like some common factors like risks, like returns and stuff. Chloe?
I would say like age, like if you're younger, like or like teens or something, you can like invest more in like stocks because you don't really have to worry with like risks because you're really young. But when you're older, like seniors, like 80 years old, you should like worry more about the risk and like have your portfolio more ready for bonds so you have enough money to pay for the bills and yeah.
Yeah, amazing, Chloe. So personally, since you're 12 right now, I think how would you select the best one?
Honestly, I don't really do bonds because I'm more like a stock person. So yeah.
Okay, so how would you select the best stock? Was what I meant. But
Um,
how would you build your portfolio?
what?
How would you build your portfolio?
Like by selecting, I would like look at their fundamentals, company stuff, and then see their management and returns and a lot of other stuff.
Nice. Does anyone else want to share? It's okay, like you shouldn't be like afraid of like if like you um say the wrong thing or something, you shouldn't be afraid of that. And honestly, you can't actually say the wrong thing. This is all opinion based, this question. Okay. So I overall I would select like I'll look at the fundamentals of the company. Like there's a lot of fundamentals like from debt, ROIC, net returns, gross margins, current ratios, PEs, like free cash flow, etc. I would also look at like insider trading, buying, etc. Um, I would also look at like the risk of a stock too. And I said it mostly depends on like your age too, as Chloe said. If I were older, I would probably like want to have like slightly less risk, you know. But since I'm like 12, I would honestly go for like higher risk, higher rewards. So right now I'm just gonna share like a pretty simple method. It's like using like some basic metrics. Um, like for example, Sharpe ratios and stuff. So like these are some pretty basic metrics, but these are really good metrics, and it's a really good like it's a really good method to like select a portfolio or some stocks. So number one, get your monthly returns over at least 5 years. Oh, like, this is for a portfolio. So like if I like am choosing between mutual funds, I would like get the monthly return of a mutual fund over at least 5 years. So more than 10 years would be better, but some mutual funds don't last that long. Step number two, calculate the following metrics. So there are many, but the following are the most important ones for like calculating like the returns of a portfolio or yeah, of a stock. So here's a compound annualized growth rate, growth return, standard deviation, maximum drawdown, and Sharpe ratio. So the compound annualized growth rate or growth return, sorry, it's calculated by this formula. So I'm not exactly going to elaborate that much on like the mathematical proof behind this formula. So there's basically the ending value divided by the beginning value, um, and or like the ending value and beginning value, and that's to the power of 1 over the number of years minus 1. So given a portfolio, in year 1, the return is 20%. In year 2, the return is negative 15%, and in year 3, the return is 10%. So what do you think its CAGR would be over the 3 years? Um, if you don't want to calculate this mathematically, as I guess it would be kind of lengthy to calculate it mathematically, fine, what would you guess its CAGR be over the 3 years? Like the compound annualized growth return.
Wait, what's the initial investment for the example?
And CAGR in percentages then. You can calculate in you don't have to know the number of money to calculate the beginning value and ending value. If you really want to just say it's 100. Okay, it's if you're saying it's 100 and you can get it out in calculators, if the beginning value is $100, then what would you predict the CAGR is over the 3 years? Okay, then, and you know you can just like say your estimated one. Okay, so the ending value over beginning value is basically 1.122. So this is like a decimal. So using the above formula, we can calculate that the CAGR over the 3 years for a given portfolio is approximately 3.91%. So on average, it earns about 4% every year. Next is the standard deviation. This is to measure the dispersion of returns around the mean, and is often used as a measure of risk. A higher standard deviation implies greater the dispersion of data points around the mean, blah blah blah. Basically, like it's just like measuring like the risk and like the variations of a portfolio. And obviously, the smaller the standard deviation, the better the portfolio is. So here is another formula for the standard deviation. And no, I will not ask you to calculate this right now. There's also drawdown and maximum drawdown. A drawdown refers to the decline in the value of a single investment or an investment portfolio from a relative peak to a relative low. So you can see from this high point to this lowest point, that's a 20% drawdown. Basically, it's the percent difference between the previous high point on your equity curve and the lowest point on your equity curve. And again, the smaller the max drawdown, the better a portfolio is. Because of course you wouldn't want it to go that very have very high losses, right? Or have very low loss, have a lot of losses. There's also Sharpe Ratio. Sharpe Ratio is a measure of risk-adjusted performance of the portfolio. It is calculated by dividing the mean monthly excess return of the portfolio minus the risk-free rate by the standard deviation of the excess returns. And the displayed value is annualized. The higher the Sharpe Ratio, the better our portfolio is. So here's the formula for the Sharpe Ratio. It's the return of a portfolio minus the risk-free rate over the standard deviation of the portfolio's excess return. And the annualized Sharpe Ratio is basically calculated like this. Again, you don't have to calculate this, but just like to compare it, usually any annualized Sharpe Ratio that is greater than 1 is considered acceptable to good. And the higher the Sharpe Ratio, the better it is. An annualized ratio that is greater than 2 is rated as very good. And an annualized ratio greater than 3 is considered like excellent, like super, super, super good. But active management, for example, like in a mutual fund or something, can achieve this, but index funds can't achieve this. Index funds are like the 1 to 2 range, I think, like 1.5, I think. An annualized return that is an annualized return that is less than 1 isn't very good usually. So here's a calculation example, assuming the risk-free annual return is 4.5%. This is a Hoperation fund, SPY and QQQ. So step 1, you convert the annual risk-free rate to a monthly rate. You calculate the average monthly return of the portfolio. You calculate the excess return. You recalculate the standard deviation of the portfolio's monthly returns. You recalculate the monthly Sharpe Ratio. You recalculate the annualized Sharpe Ratio, a lot of calculating. And then you get Hoperation fund Sharpe Ratio. So this is 2.45%. Over here you can see an annualized ratio that's greater than 2 is rated as really good. So this is like a very good Sharpe Ratio. As I said before, SPY and QQQ, since they're index funds, they don't have a very high Sharpe Ratio. It's still good, 1.3 and 1.28, but it's like usually index funds can't reach to like above 3 or a lot of above 2. So now let's compare the S&P 500 index fund and the 3 famous portfolios. Bogleheads, 3 funds, David Swenson, Yale Endowment, Ray Dalio, All Seasons, and Vanguard 500. Oh, that's the index. So commonly a portfolio is good at some metrics, but bad at other metrics. So different investors will prefer different trade-offs among these metrics, because usually portfolios, they have like this good attribute, and then sometimes they have not so good, and usually like portfolios, they're good at some metrics, bad at other metrics. It depends on what your own personal preference is. So what portfolio would you prefer and why? Okay, this is an open-ended question. You don't have to after a while you can just look at this and just choose what you would want. Yeah?
I
Chloe?
would choose the Vanguard 500 index investor portfolio because the final balance is the largest, the compound annual growth rate is higher than all, and then the standard thing is pretty good, and then their best year is also really high. I mean, the worst year is like slightly lower, but like other than that, they have the best Sharpe ratio, and I think it's pretty good.
So you would choose the one that has the highest return? So yeah, Honestly, this is like a really good index. Like it has the highest return out of all of them, and like the highest compound annualized growth return. It's it's slightly riskier though. Like its standard deviation is higher, which means it's like riskier. And its worster is also like has the lowest returns. Max drawdown is lowest, but the Sharpe ratio is pretty good. And since I'm only 12, I don't really need to worry about risks that much. So yeah. Anyone else have a different opinion than Chloe? From Chloe? Okay, so does anyone else have another opinion that's different, or do you guys all agree with Chloe? Okay, so yeah, honestly, since I'm only 12, I would choose this one, because this index, because it has the highest returns, while it does have, like very high risks too. It's kind of like a trade-off, but I wouldn't exactly care about risks right now. But what about in different scenarios? Say you are 30 years old. Oh, no, fine. Say you're in college then. What would you which portfolio would you choose then? Would you still choose the index? Okay, Chloe?
Maybe the Bogleheads or David Sweeson. I don't know. Either the first one or the second one. I would choose the first one maybe.
Yeah, it's like seems to have higher return and it's like pretty good too. Does anyone else have another different opinion? I would recommend you guys like if you guys have like a different opinion, you guys like should participate in this. Okay. Honestly, I personally would choose the Vanguard 500 NX investor if I were in college. Why? Because if I'm in college, I would be like 20 years old approximately, right? So I would still not be too concerned about returns. But say you're 40 years old, um, which portfolio would you choose then? Hi?
I would probably choose the David Swenson or yeah.
Nice. Why, Kai?
I guess it's like a little bit safer and you're older and it still makes relatively more money.
Yeah,
Yes.
and like it makes pretty good money, really. Um, great. William?
Well, I partially agree with Kai, but like I think I think like it depends on how much money you have when you're planning to retire. Like if you have a lot of money, you can then you can take the risk and spend like $100,000. But if you don't, then I'd actually stick with the Bogleheads refunds because it it is somewhat risky. Um and the Sharpe ratio isn't that good, but like it still generates a decent amount of money. So
Yeah, I agree. Since you're older, like you might want like a a portfolio that like generates a good amount of money, but like it's like it's like has less risks. Hmm. So how about when you're 80 years old and you're on retirement? What's it if you're like retired, which portfolio would you choose then? Isabella?
I'd probably pick Bogleheads 3 funds because it's more secure, has like an index fund. So yeah.
Ah, nice, Isabella. Um, but it's the secure part. Um, It has a max drawdown of negative 43% too. So yeah, that's like lower than Vanguard 500 index investor. But like, yeah. Mm. William?
Um, I'm going. You said I would go.
yeah, you go.
I would choose like the Ray Dalio because like it's kind of cheap and And what? No, because we're gonna find out.
The balance is what you earn.
Oh. Wait, what?
That's crazy. Okay. If you're 80, I honestly feel like the Ray Dalio would actually be okay because it's only because it's less risky. It's because it has a lower standard deviation. It has like a high Sharpe ratio. So yeah.
Yeah, I yeah, I agree. I would honestly pick Ray Dalio all seasons if I were retired because it has a good Sharpe ratio. It doesn't earn as much compared to the others, but its max drawdown is only negative 20%. So I mean, slightly less risky. Okay. Okay, now there's some extra like predictions of the stock market over the next 10 years according to some um like some basically like metrics kind of not really. So there's a P/10 ratio. Or it's called a Shiller PE ratio. I'm assuming you guys have heard of PE ratios. Okay. Well, the P/10 ratio is a valuation measure for equities that uses real per share earnings over 10 years. So the P/10 ratio also uses smoothed real earnings to eliminate net income fluctuations. And the P/10 ratio is also known as the cyclically adjusted price to earnings, or CAPE ratio, or the Shiller PE ratio. So basically, it's like a smoother evaluation method for a stock or like the or like a stock with an index or like the market. So the current Shiller ratio is 35. You can see here since 2024, March 22nd. The the P/10 ratio versus 20-year stock market return, as you can see from the chart here. So like there's two main lines here. This other line is not really highlighted. So you can see there's two main lines here over here and over here. So this here is the annual total return over 20 years, and this is the P/10 at the start of the 20 years. So you can see these like just a bit of a correlation. This is our P/10 right now, so 35. So you can see from this line, it kind of, you can see from this line here, it kind of corresponds to this point in the graph. So about less than or equal to a 7% annual return over the next 20 years is predicted over by this P/10 ratio. So this can like maybe like predict returns over the next few years. Besides the P/10 ratio, there's also a normalized P ratio. This is another valid predictor of long-term stock market performance. As you can see from this chart. Our P ratio is around this area. This normalized P ratio is around this area. So this corresponds to about a 2%-ish return for the stock market. So 0 to 3% annual return over the next 10 years. So both predictors imply that the annualized return of the market over the next 10 years ranges from 0 to 7%-ish. What do you think this means for the volatility of the stock market? Does anyone want to share? Hold on, does anyone want me to repeat something first of all? Okay. Valencia?
Um, I think this means that overall the stock market will still grow, of course, but it would have up and down.
Yeah, excellent, Valencia. So I mean yeah, the stock market will probably, I agree, will probably also grow, but it doesn't look at it's gonna be growing that much according to these particulars. So situation one is here where the stock market slowly goes up over the next 10 years. Situation 2 is the stock market experiences a large surge upwards, then a sharp decline, followed by a pattern of alternating rise and falls. So do you think, honestly, the stock market will look more like this, or like situation 1 or situation 2? William?
I feel like the stock market's gonna have like a lot of ups and downs. And then I also feel like within the next 10 years, it's definitely gonna change. And some stocks are gonna become better, some stocks are gonna become worse. So I feel like if we invest in stocks now, like it might be a lot better than if we invest in it like next year, maybe like 2 or 3 years later.
Yeah, it's always like best to invest early, right? Um, so Max? Hmm? Uh, Max, do you want to answer? Hold on. I don't think I can hear you if you're trying to talk. Mm, okay, whatever. Well, you can like think about it later then. Can you guys hear me? Okay. So both predictors and
Okay. Wait, can you hear me?
yeah,
Now you can?
yeah, now I can.
Okay. Okay. Uh, so I also think it's the second situation, generally speaking, because in the past, it it has gone up and down a lot. Like over like in 2024, like it went up generally, and then when Iran and Israel uh like almost had like conflict, it sharply dropped, and then it went back up after it was like peace again. So I think that's gonna be like the trend for majority of the time.
Yeah, interesting, Max. So I believe the stock market will probably have like kind of a combination. I believe it will go up and down a lot too. So both predictors imply that the annualized return of the market over the next 10 years ranges from 0% to 5%. You can see from this chart. Actually, in 2022, SPY had a loss of 18.17%, and in 2023, it had a gain of 26.19%. So while you might think it might end up with a pretty large positive return, it actually ended up with an annualized return of 1.62%. Because if you- if like a value of a stock or something, as I think a famous investor once said, if something goes down 50%, it will have to go up 100% to like go back to its original position. And in QQQ, 2022, it had a loss of 32.58%, and in 2023, it had a gain of 54.85%. So a total return of 2% approximately. So you can see this kind of matches the predictors because the predictors like predict like or imply that the annualized return will be from 0 to 5%. So far, not too great overall. But I believe the market it will still have gains, but I believe it will not be like the best in the near future. Okay, so our next book is gonna be One Up on Wall Street. Okay, I know you guys. I think we read this last year, but a lot of you might have already forgotten, and it's always good to review because this is a really good book. Like it has some very good like important strategies you can use in investing to earn a lot of money. So. So yeah, this is Peter Lynch. He is a pretty famous investor. He was hired well, he was the head of the Fidelity Magellan Fund, which grew like super big. Like by the time Lynch resigned, it had grown to $14 billion, and it was only started as 18 million. So like he's a really good investor, really famous. Has earned a lot of money. Yeah. So next time we're gonna be reading this book, and if you've already read it, don't be afraid. You can just review it. And if you've already read it, you can just you can just quickly read it. Then it's always good to review, right? And a lot of you might have already forgotten, and I think many of you haven't even read a book. So yeah, our next book will be like this. Does anyone have any questions for me? Or does anyone want to share something? Okay. And yeah, thank you for coming to this reading club. I guess we went a little bit off time, but whatever. Anyways, thank you for taking the time to come here. I hope you guys learned a lot of things and had fun today. Also, how was your day today? Busy? Good? Medium, bad, good? Yeah. Well, overall, thank you guys for coming. And this concludes the reading. Our reading.